35-year-old in good health can buy $500,000 of life insurance coverage for roughly $25 a month. Or they can buy $500,000 of life insurance coverage for roughly $350 a month. Same coverage amount, same death benefit paid to the same family. The difference is the product type, and the reason one of those products dominates what insurance agents recommend has nothing to do with which one is better for you. Life insurance companies paid out $55 billion in agent commissions in 2023, according to the American Council of Life Insurers. That is not a cost of doing business. It is a designed incentive structure. Agents who sell whole life insurance earn commissions of 70% to 110% of the first year's premium. Agents who sell term life insurance earn 50% to 80%. On a premium that is often 6 to 10 times smaller. The absolute dollar difference in commission per sale is enormous, and it runs consistently in favor of the more expensive product. About 102 million American adults are uninsured or underinsured on life insurance, according to the 2024 LIMRA Insurance Barometer study. The number one reason they give, it's too expensive. Most of them are overestimating the cost, because what they picture when they think of life insurance is the expensive product, not the affordable one. Here's how the two products actually work, who each one is designed for, and what the commission structure means for the advice you receive. Term life insurance is the simplest financial product in existence. You pay a monthly premium. If you die during the term, typically 10, 20, or 30 years, the insurer pays the death benefit to your beneficiaries. If you outlive the term, the policy expires and you get nothing back. There is no investment component, no cash value, no savings account, just insurance against dying while people depend on your income. Because term insurance is simple and temporary, it's cheap. According to Guardian Life's 2025 rate data, a healthy 30-year-old male can buy $1 million of 20-year term coverage for $53 per month. A healthy 30-year-old woman pays roughly $63 per month for the same coverage. Most people who need life insurance, young adults with dependents, people with mortgages, parents, need it most during their working years, when their income is what their family depends on. Term covers exactly that window. The critique of term life is accurate. Most policyholders outlive their term and never receive a payout. Insurers price this in, but that's not a flaw. It's the correct outcome. The policy worked. You stayed alive, your family was protected during the years they needed it, and you paid a modest premium for that security. Calling term life a waste because you didn't die is like calling car insurance a waste because you didn't crash. Whole life insurance is permanent. It doesn't expire. As long as you pay premiums, the policy stays in force, and the death benefit is guaranteed to pay out whenever you die, whether that's at 45 or 95. It also accumulates cash value over time. A portion of each premium goes into an account that grows at a guaranteed rate, typically 2% to 4% per year, and can be borrowed against. That sounds appealing, but here's the math. The same $350 per month you'd pay for a whole life policy could buy $25 of term coverage and leave $325 available to invest independently. Historical S&P 500 returns have averaged approximately 7% to 10% annually over long periods. The cash value in a whole life policy grows at 2% to 4%. If you invest a $325 difference in a low-cost index fund for 30 years at 7%, you accumulate substantially more wealth than the cash value component of the whole life policy, while carrying the same or greater death benefit through the term policy. This is the buy term and invest the difference argument, the consensus position among fee-only financial planners who have no commission incentive in either direction. It is not universally correct. There are specific circumstances where whole life makes sense, including high net worth estate planning, business succession planning, and individuals who genuinely cannot maintain investment discipline without a forced savings mechanism. But those are narrow cases, not the general recommendation that whole life receives from commission-earning agents. On a whole life policy with a $350 monthly premium, $4,200 annually, an agent earning a 100% first-year commission receives $4,200 in the first year alone. On a term policy with a $25 monthly premium, $300 annually, the same agent earns at most $240 at an 80% commission rate, That's a 17-to-1 difference in first-year compensation for recommending the more expensive product. Agents are also not legally required to disclose their commission amounts unless you ask directly. The recommendation you receive arrives without any transparency about the financial incentive attached to it. The commission structure creates systemic pressure. One former financial advisor described internal sales culture. If you didn't hit your life insurance numbers for 2 quarters in a row, you'd be called in for a business planning meeting. That pressure does not disappear in the room with the client. The market reflects this. In 2024, whole life insurance held 37% of new individual life insurance premiums, despite being the more expensive, less flexible product for most buyers. Term life held just 19% of new premiums. The market share of each product correlates closely with its commission rate, not with its suitability for the average buyer. Here's the framework. There are 2 types of financial professionals who can advise on life insurance, and the distinction matters enormously. A fiduciary financial advisor is legally required to act in your best interest. Fee-only fiduciaries charge by the hour or as a percentage of assets under management. They receive no commission from product sales. Their recommendation is structurally unbiased on the term versus whole life question. A commission-based insurance agent is not a fiduciary. They operate under a suitability standard. The product they recommend must be suitable for you, not necessarily optimal. There is a meaningful gap between suitable and optimal when one product pays 17 times more in commission than the other. This is not an indictment of every insurance agent. Many provide genuine value and make honest recommendations. It is a description of the structural incentive they operate under, which you should know about before accepting their advice on product type. The life insurance gap, 102 million adults underinsured or uninsured, exists in part because the product most visible and most recommended is the expensive one. The affordable product exists, is widely available, and for most people with dependents is exactly what they need. The barrier is not affordability. It is awareness, and a distribution system structured around selling the product with the highest margin. 3 things to do if you need life insurance or are reviewing existing coverage. First, before any conversation with an agent, get an online term life quote for the coverage amount you need. PolicyGenius, Haven Life, and Ladder all offer instant quotes without a sales call. Know what term costs before anyone tells you what you need. Second, if you work with an advisor or agent, ask directly, are you a fiduciary? And what commission do you earn on the products you're recommending? A fee-only fiduciary will answer both questions clearly. If the answer is evasive, that tells you something. Third, a common rule of thumb for coverage amount is 10 to 12 times your annual income. A 30-year-old earning $60,000 who wants to protect their family for 20 years needs roughly $600,000 to $720,000 in coverage. At current term rates, that's approximately $30 to $40 per month. This video is educational content, not financial advice. Your specific situation, dependents, debts, and goals all affect what coverage you need. A fee-only financial advisor can give you personalized guidance without a commission attached. Next week, car insurance. Why your rate keeps going up, what your credit score and zip code have to do with it, and the coverage decisions most people get wrong. Subscribe so you don't miss it. 1 video a week, no filler.